You owe back taxes to the IRS or state, and you're looking for solutions to deal with the debt. You've thought about the offer in compromise and have even tossed around the idea of bankruptcy. You call the IRS and they'll offer to put you into an installment agreement, but the monthly payments are too expensive. Are there any other options? Are there any other types of payment plans? The 7 types of IRS payment plans. That's the topic of today's video on the other side of the break. What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I've helped thousands of clients with unfiled returns, back taxes, tax liens, and that's right, IRS levies. If the IRS took your check, the Levy King will get it back. 1-877-LEVY-KING, LevyKing.com. I'm also the author of End the Tax Nightmare, Insider Secrets to Beat the IRS and Reduce Your Tax Debt. Inside the book, I'll show you how to stop IRS levies, liens, and garnishments without paying the tax in full, how to set up the payment plan you want and not the one that they want, and how to potentially settle your tax debt for less than you actually owe. My book has been a top seller on Amazon for years. You could buy it right now for $19.99, but I want to give you a copy of the book absolutely free. Just go over to my website, www.endthetaxnightmare.com, and enter your name and email address, and I'll send you a copy right away. No charge, not even for shipping, totally free. Before we go any further, I want to take a moment to ask you to subscribe to our channel, and don't forget to smash that like button and hit the notification bell for the YouTube algorithm so that YouTube lets you know each and every time we drop a new video. Okay, let's dive into today's content. If you owe back taxes, chances are you've considered an IRS payment plan as a means of resolving the tax debt. You've probably even gone to the IRS website to look at how much you'd have to pay. Today, I'm going to break down a few of the types of available installment agreements, also known as IRS payment plans, and touch on their pros and cons. Okay, so the first up is what they call the short-term payment extension. If you owe $10,000 or less and you can pay your tax debt plus the interest and the penalties within 120 days or 4 months, a short-term payment extension might be your best option. This plan allows you to make manageable monthly payments. There's no minimum payment, and you're guaranteed to be accepted into this type of payment plan if you meet the criteria. You can apply for a short-term payment extension when you file your tax return or online at irs.gov. Next up is the traditional installment agreement. If you need more than 4 months to pay your tax debt, including the interest and penalties, and the amount that you owe is less than $50,000, the traditional installment agreement may be for you. This is the most widely used type of IRS payment plan. You'll get up to 72 months to pay the debt in full, and you usually won't have to provide any type of financial information such as bank statements and pay stubs. You can apply online or submit an IRS installment agreement request, which is Form 9645, link in the description below. Next up is what we call the high debt installment agreement. Now, so if we look at high dollar amounts, things start to become a little bit more complicated when you owe over $50,000 in tax debt, or you need longer than 72 months to pay the tax debt plus the penalties and interest. Once you cross over this threshold, you won't be able to apply online, and you might want to seek professional help. This is because the IRS will require that you disclose certain financial information such as assets, liabilities, income, and expenses. You'll likely have to prepare and sign an IRS Form 433, and misrepresenting your financial situation here could bring its own set of problems. Next up is the Stair-Step installment agreement. This is a type of payment plan where you pay off your debt over 5 years, but your monthly payments will increase each year. This may be a good option where you can reasonably expect that your income will increase every year, or you'll have certain types of expenses that you know for sure will be paid off as each year goes by. So for example, let's say in year 1, your payment is $100 a month. In year 2, you know that your car will be paid off. You won't have any more car payment. So you can afford to increase that monthly payment to $500 a month to the IRS. In year 3, let's say your toddler will be school age, so you won't need to pay for daycare anymore. Therefore, you can increase the payment up to $1,000 a month to the IRS, which will pay off the debt in full, plus penalties and interest within 5 years. The key with the Stair-Step plan is you need to know that either your income is going to go up almost for certain, right? Or that your debt is going to go down, which will allow you to handle an increasing monthly payment. But you got to be sure you kind of know that in advance. That's not one to sort of play around with. The next up is the Conditional Expense Installment Agreement. When negotiating an installment agreement, the IRS takes your monthly income and expenses into account to determine your ability to repay your tax debt. Your monthly expenses will be divided into 2 categories. There are necessary expenses and conditional expenses. Necessary expenses are expenses that go towards your health, welfare, or the production of income. This is the so-called necessary expense test: health, welfare, production of income. Conditional expenses are all other expenses that do not meet the necessary test. Despite this, though, the expense might be still allowed if you can pay the debt within 3 years and you can demonstrate to the IRS that it would help you to be able to stick with your installment agreement. Let's talk about business tax debt. For small business owners, one of the worst types of tax problems involves payroll taxes. Payroll taxes are the taxes that an employer is supposed to withhold from his employees' pay and pay over to the IRS on the employee's behalf. Companies get into trouble when they withhold the taxes but fail to pay the money over to the IRS. This is the worst type of tax problem because payroll taxes are the IRS's #1 enforcement priority, and the penalties here can be extremely high. There are a few different types of business installment agreements, but for this video, I'm really going to focus on the in-business trust fund installment agreement. All right. So to secure an in-business trust fund installment agreement, the business must agree to make monthly payments that are sufficient to pay the liability in full within 24 months or prior to the expiration of the time that the IRS has to collect the debt, known as a CSED, or Collection Statute Expiration Date. If the business owes between $10,000 and $25,000, it must also agree to make these payments via direct debit from its bank account. Handling payroll tax debt, is probably not a do-it-yourself project. Why, you ask? Because if you can't negotiate a deal, or if the business is struggling and can't afford to make the payments towards its tax debt, the IRS could essentially force the business to shut down. It'd be a bad result for everybody involved. Last up is probably one of my favorites, right? The final one for today is the partial pay installment agreement. A partial pay installment agreement is a payment plan that allows you to pay off a portion of your debt in monthly payments until the tax liability expires. You see, the IRS has 10 years to collect back taxes. All the debt has to be collected before the so-called Collection Statute Expiration Date, or CSED. Watch this video to learn about the CSED dates. Anything that is not collected before the CSED date becomes uncollectible. Link in the description below for more about CSED dates. For example, let's say it would take a monthly payment of $300 a month to pay off your $36,000 balance before the CSED date. But we can demonstrate to the IRS that you can only afford to pay $100 a month. The net result is that you would only repay about $12,000 of the remaining debt, and the other $24,000 would essentially be forgiven because it would become uncollectible, right? The PPIA, or the Partial Pay Installment Agreement, is one of my favorite strategies to help taxpayers resolve IRS problems. I like the partial pay because it effectively gets you out of a tax problem without paying the balance in full. It's kind of similar to an offer in compromise in that way. However, it's different from an offer because it can be accomplished a lot more quickly and with less hassle from the IRS. Before I wrap this one up, I want to answer a couple of questions I get all the time about installment agreements. The first question I hear a lot is, what happens when you and the IRS don't see eye to eye? Can the IRS refuse to grant you an installment agreement? The answer here is absolutely yes. There are 3 reasons that the IRS might reject a proposed installment agreement. Basically, if the first is that if the IRS thinks that your living expenses are extravagant, they think you're spending a lot of money maybe on charity or on large credit card payments, they can reject your installment agreement request, right? They can make you trim in your expenses or disallow some expenses, but they could also just flat out reject it, right? The second is that if the information that you put on your Form 433 is inaccurate, untruthful, or just incomplete, the IRS could assume that you're hiding additional income and property and reject your installment agreement because of that. Lastly, if you've already defaulted on a prior payment plan, the IRS will be hesitant to accept your new proposal for an installment agreement. The second question I get all the time is, can the IRS revoke an installment agreement once it's already in place? The answer here is also yes. There are cases in which the IRS may revoke a taxpayer's installment agreement. While you and the IRS are both bound by the agreement's term, should any of the following be true, the IRS may revoke your payment plan. The most common reason that the IRS defaults or revokes a payment plan is that you didn't make your payments on time, right? The installment agreement is going to require that you make monthly payments on a set date, right? And if you don't make those payments, they could revoke it right away. But what they usually do instead is give you 30 to 60 days to sort of cure the default before they go ahead and yank the IA from you, okay? The second most common reason has to do with your tax obligations. When you're in an installment agreement or an offer in compromise or currently non-collectible, you are required to file all of your tax returns on time for usually going to be 5 years at the most, but sometimes a shorter window could be applicable. If you don't file your tax returns, then it will default your installment agreement, right? The final reason that I have seen in my practice for the IRS to revoke an installment agreement has to do with basically them finding out that you lied. OK, so if they have reason to believe that you misrepresented your factual situation when you filled out that collection information statement, the Form 433, then they can and they will revoke your installment agreement, throw you back into collections, and you'll have to seek another remedy to solve your tax problem. So don't do that. All right. Speaking of tax problems, I want you to know that there are special programs in place to help you solve your IRS tax problem and get a fresh start. But how do you know if you qualify? You see, no 2 cases are exactly the same. So how do you know exactly how much you can settle for? Well, lucky for you, I've created a free tool to help you get qualified for a fresh start. Just head over to www.levyking.com. Fill out, answer a few simple questions, and we'll help you figure out your eligibility. Just follow the prompts. It'll guide you right through. Levyking.com. That website again, www.levyking.com. Or you can give us a call at 1-877-LEVY-KING. Again, that's 1-877-LEVY-KING. All right, guys, that's it for this week. Talk to you later. Bye.